DCG, one of the biggest conglomerates in crypto, appears to be dumping some of their assets. This has resulted in drawdowns across some of the major altcoins on the market like Filecoin, Flow, and Near Protocol, dropping over 15 to 20% over the last 24 hours. So in today's show, I want to go through exactly what is happening to DCG, what this situation means for the immediate future of crypto, whether this contagion could get even worse if DCG goes down, and explain the likelihood of whether I think this could or couldn't happen. Because obviously there's a lot of panic in the market right now. There's lots of assets being dumped harder than ever off the back of the latest FOMC. And I want to give you guys some clarity and a bit of overview as to what is happening with this entire situation. So the first thing I want to discuss before we get into the contagion and the assets that DCG appears to be dumping, I also have found some secret assets that not many people are talking about that they may have exposure to. I want to talk about exactly what went down and what went on with DCG. And in order to do this, I need to go through DCG's origins and look at what led to their downfall, because their downfall didn't start with FTX. Their downfall actually started way back in the 3AC lunar days. So just so you guys understand, DCG is a conglomerate. It is comprised of three different parties. One, Genesis, which is their crypto trading, lending, and asset custody arm for institutional clients. Then it has Grayscale. Grayscale is the arm that's essentially their asset manager. This is host to the Grayscale Bitcoin Trust, which you can use to purchase Bitcoin on the stock market. And then also they have CoinDesk, which is their news outlet. So essentially, DCG has three major pieces: Genesis, Grayscale, and CoinDesk. Interestingly, CoinDesk were the ones that were famously known for leaking the Alameda balance sheet, which ended up contributing to the very beginning of the FTX collapse. So there's been many weird events that have happened over the past few weeks in relation to DCG, but those are the three major components that you need to know about. Now, the problem really escalated, and some of the problems that were underlying with DCG started to come to light during the FTX saga. So we saw on November 8th, they came out and they said they had no material net credit exposure to FTX. On November 9th, they said, okay, we lost $7 million. On November 10th, they said, okay, we have $175 million locked in FTX. By November 21st, they were kind of alluding to the possibility of a bankruptcy and needing to do a capital raise. So how did this happen? How did they go from saying they had no material credit exposure, being seemingly fine, having their lending platform Genesis operating, to potentially rumors of the Grayscale trust being unwounded? Well, let's go through exactly what caused the problem. So I think we can rewind all the way back to July 6th, where the Genesis CEO disclosed that a large counterparty they liquidated in June was defunct. This was obviously the giant Three Arrows Capital. So the loans that they extended to 3AC had an average margin requirement of 80%, and they assumed certain liabilities of Genesis. In the wake of Celsius, Voyager, and the BlockFi collapses, Genesis appeared to have mitigated its losses. But on July 18th, 2022, the 3AC bankruptcy proceedings showed that 3AC owned Genesis a whopping $2.3 billion. So what this means is at the time that 3AC went bankrupt, it was unveiled that Genesis was actually owed a whopping $2.3 billion, as Genesis was secretly loaning money to 3AC. So essentially, to recap exactly what went down here, Genesis made a $2.3 billion loan to 3AC, some of which was an unsecured loan. The loan was denominated in US dollars, which means the collateral was linked to crypto assets, which created in value. So when your collateral is linked to crypto assets, which drop, your collateral value lowers, and then that can lower the margin requirement for getting called on a loan. 3, the collateral value was worth 27% of the loan outstanding. So it was highly under collateralized in the end. And obviously 3AC could not pay it back. Now, to understand exactly how this situation occurred and how there was a $2.3 billion hole that was unveiled in Genesis' balance sheet off the back of this loan to 3AC, we have to understand the synergy between Genesis, Grayscale, and 3AC. They were extremely intertwined, and this is what led to there actually being a hole. So from the launch of the GBTC, the Grayscale Bitcoin Trust on the stock market, it traded at a 20 to 60% premium to the underlying Bitcoin. So essentially what this means is that people were paying a more than 120 to 160% 50% on the price of Bitcoin during the very early days, as we could see according to this chart, to actually purchase Bitcoin through the unit trust instead of purchasing Bitcoin itself. The premium originally existed on the Grayscale Bitcoin Trust due to the ease of being able to purchase it through the stock market, to the ETF conversion, because people believed there'd be a ETF eventually that Grayscale would convert into that would allow easy redemptions. However, it was quickly realized after that that there wasn't going to be enough kind of retail demand in crypto after prices start dropping to prop up the NAV, the discrepancy between the NAV and the current price of the Grayscale Bitcoin Trust. So what happened is the premium turned into a discount. So people realized it actually wasn't that hard to buy Bitcoin. They could just buy it on an exchange. And the SEC decided to strike down their attempt to start an exchange-traded fund, an ETF, which would have been a redemption mechanism between the futures Bitcoin and the spot Bitcoin, so they'd be able to swap it. So what that meant is GBTC holders couldn't redeem their shares for Bitcoin, and this essentially meant their Bitcoins are stuck. So what actually happened over time was the premium turned into a massive, massive discount, which is now sitting around 47.85%. So if you purchase Bitcoin through the Grayscale Bitcoin Trust, essentially you are getting a discount of 47% in your Bitcoin. But there are a few major underlying risks, which is why this is the case. Because at face value, you'd sit here and say, wow, I can get 47% off Bitcoin. This is amazing. It's like free Bitcoin. Well, that's not exactly the case because of how interlinked all this is. And if there is a major problem with Genesis, like we're seeing right now, and DCG has to unwind the Grayscale Trust, this could have ramifications for the holders of that trust, hence why the market doesn't seem too keen to buy into it off the back of the fact that there is not a lot of retail hype in the market, which drove it in the beginning. And two, we have viable other alternatives which are less flooded in the market, like Binance, which you can use to purchase Bitcoin anyway. So what happened in the beginning with 3AC was during the sunny days when this was still at a premium, probably during the first year, even before it turned to a slight discount, 3AC was buying Bitcoin and contributing Bitcoin to the trust. So in exchange, they received shares in the Grayscale Bitcoin Trust, and the shares that they received were locked for 6 months. So thereafter, 3AC sold them in the open market and netted a return depending on the premium. So as long as the premium remained, 3AC was netting huge returns on a simple 6 months arbitrage trade. But obviously, they couldn't resist adding a ton of leverage as classic Three Arrows Capital style. They borrowed USD from Genesis to fund the purchase of more Bitcoin, which they would then use to contribute back to the Grayscale Bitcoin Trust. So 3AC used its GBTC shares as collateral, so everyone was profiting because what was happening was the Grayscale Trust was loaning money to 3AC. 3AC was using that money to buy more Bitcoin. They were levering up, contributing back, getting shares, and essentially it was kind of a roundabout of borrowing and lending and borrowing and lending and borrowing and lending. And what this meant is that 3AC ended up building a very strong position in GBTC. It owned over 39 million shares worth $1.3 billion by the end of 2020. And what this meant off the back of that was Grayscale, alongside 3AC, was printing money. They were charging a 2% management fee. So the more Bitcoin that 3AC purchased using the loans, the more that they were making on the management fees. Because if you have more Bitcoin in the trust, that means the 2% equates to a higher monetary return every single year. And so they were kind of incentivized to keep loaning and keep this merry-go-round going around and around and around because they were earning fees, right? And this resulted in their revenue peaking at $144 million a quarter. So Grayscale, which essentially had no cost to operate, was nearly all profit. And essentially that ended up benefiting their major beneficiary, DCG, as they run Grayscale, obviously. So everyone was incentivized to keep the mechanism going. Genesis was underwriting favorable loans to 3AC, and the parent company, DCG, made up for it from Genesis trading business and the Grayscale fees, which is absolutely crazy. And we can see, if we look at the chart, this chart here below, we can see the simultaneous growth of Genesis and Grayscale. So as Genesis grew, Grayscale grew. But what happened was the music stopped eventually, because once GBTC traded at a discount to spot Bitcoin, it was no longer profitable for 3AC to play these games. It was no longer profitable for Genesis to loan money to 3AC for them to buy more Bitcoin, because remember, the arbitrage for them only worked as long as there was a premium. As soon as this went negative, things started to unravel a bit as 3AC had to sell their GBTC shares at a discount to Bitcoin spot to fund their margin loans. So what happened was the selling further widened the spread, which caused even more selling, which resulted in even more discrepancy between the net asset value, the NAV, and the market price to open up. And we eventually saw this come down even further to around 20% at this time. So DCG had wrong way risk. It was operating a business and collateral was linked to the same thing. The collateral that was linked to GBTC premium over Bitcoin spot price. So they were essentially leveraged on their own fund. So I'm just kind of framing the logic for you guys as to how all this started, and then obviously we'll get into the current situation. So what happened was clearly they were highly levered up with 3AC, but what happened was 3AC ended up collapsing in July, as you guys know. But Genesis was able to kind of wiggle itself out of a very tricky situation, because this entire 3AC implosion resulted in the $2.3 billion loan that Genesis was loaning 3AC to be written down to zero. So that's a loss on their balance sheet that Genesis had to take. $2 billion written off due to their loans to 3AC to kind of play those games that they were playing with the premium on the exchange. However, Genesis didn't actually implode straight away because they were able to bail them out. DCG was assuming liabilities of Genesis. They technically, although may have been insolvent, they weren't technically bankrupt. Insolvency and bankruptcy are two different things. So they were able to keep running, and their collateral was likely sold as part of the 3AC collateral. So the proceeds gave Genesis some breathing room. So all was fine, and we didn't really hear much up until the FTX situation. Now, what happened when FTX collapsed was people were panicking. This wasn't just Genesis exclusive, but people were withdrawing their money out of centralized exchanges and centralized borrowing and lending platforms all around crypto as the risk of contagion continued to increase. People just wanted their crypto back. They didn't want to expose themselves to things like FTX anymore. So they were withdrawing their money from everywhere. And Genesis, being one of the major lenders, and their Genesis Earn program, which was their more retail-focused earning program, this was one of the victims, so to speak, of the mass withdrawals that took place. And what happened when people were withdrawing all this money, Genesis didn't have the money to pay out because of the discrepancy in their balance sheet caused by the 3AC situation that was maybe band-aided over for a long time. The FTX implosion exposed what was really happening below the surface, and this was that it didn't have all of its clients' deposits on hand. Now, this isn't dissimilar to what we see with banks. So if you guys know what happens to banks, they borrow short, they lend long. Banks essentially borrow customer deposits, loan them to individuals and businesses, which means they'll never have their clients' money on hand at any given time. But the reason banks work is because they have access to the Federal Reserve, which allows them to meet customer withdrawals, as they could just borrow money from the Federal Reserve, and there's a backstop facility in place. And it's unlikely that we see widespread panic in terms of a traditional bank run than we see in a crypto bank run. But how Genesis was operating was no different to a bank. The only difference was it didn't have a Federal Reserve, so it didn't have a bank stop, and there was no way for it to get all the money that it was loaning out back so it could pay out the people that were trying to withdraw their money. So essentially it resulted in them not being liquid enough, despite keeping some liquidity like a bank would, to pay out all their clients, which was a big problem. So essentially we're left in this situation right now where DCG, let's kind of break it down into the two entities. So Genesis, firstly, needs a liquidity infusion to fund withdrawals because people are trying to withdraw money, they can't pay it out, so they need liquidity. But Genesis business is capital intensive. It's a lending business, so it needs capital to fund the loans it originates. And now no one wants to put money into Genesis. Basically, the entire business model has gone down the toilet. And then you see DCG, which is even more intertwined with Genesis, as DCG actually owns Genesis $1.7 billion. So DCG really only has a few options now to solve this situation. And it's one, raise equity, which Barry Silbert, the CEO, has been trying to do, but to all intents and purposes has failed to do in any significant manner so far. Two, monetize DCG assets. So Grayscale could essentially monetize through selling or unwinding it, unwinding the Grayscale Bitcoin Trust, which isn't something that they probably want to do, but they could be forced to, and that obviously introduces inherent risk to the Bitcoin Trust, which is why it's trading at a minus 48% discount to its NAV value. And essentially monetizing Grayscale means the end of DCG, because Grayscale is the main revenue driver now. With Genesis kind of going to shit, the only way the DCG company is making revenue is through the 2% management fees of GBTC. So if you kind of unwind the Bitcoin trust, then the business model doesn't work, because you've got CoinDesk, a media publication, making money. Well, no, obviously that business doesn't generate much capital. So winding down Grayscale would mean essentially the whole business model just doesn't work, and they're essentially going to be in even deeper waters. So then they've got two more options. They can essentially file for bankruptcy, Genesis specifically, which means that one of its largest assets, the $1.7 billion, which is loaned to DCG, gets tied up in that bankruptcy, and the Genesis creditors from Gemini Earn that deposited in money will attempt to be made whole through the bankruptcy proceedings themselves. The creditors will force Genesis to monetize its assets, but this is a very expensive and suboptimal outcome for Genesis. So what they could do is look to pre-package their restructuring, which means they kind of give and take a little bit. So they could do a liquidity infusion, a partial withdrawal, a debt for equity swap, tactics that they can use to restructure and maybe keep things ticking along. But overall, it paints a very grim picture for DCG, and none of these solutions are optimal. They're in a very tricky situation. But what has unfolded over the last day or so is we've started to see assets in their portfolios dumping much, much harder than other assets on the market. So there is some rumors going around right now, and even I personally believe that there's a strong possibility that they are being forced to sell a lot of the assets that they were invested in to get a short-term liquidity infusion to execute a restructuring, because we know they need liquidity. Now, how do you get liquidity if you're in that position? Well, the assets that you've invested in, you could potentially sell off to, because we know they had a venture arm. You could potentially sell off to get some short-term liquidity. And this is kind of what I think we're seeing at the moment. So I'm on Masari. If we go to the DCG screener, which has a list of all their assets, and look at the change over the last day, we can see that Filecoin, their main holding, is down almost 30%. Flow, another one of their major holdings, is down 15%. Many of their coins are down double digits today, and have had crazy wicks, which are very out of character compared to the rest of the market. Now, clearly the whole market is down, but these wicks are a lot more severe on DCG assets versus other assets which haven't come down as hard. This is the Filecoin chart. We can see a very intense candle on the daily and a breakdown. If we go into a shorter time frame, we can also see the breakdown was severe and very quick. And this only really led to one conclusion, which is that DCG was actually selling assets to get some liquidity here. Now, this kind of runs deeper than the assets they hold. We know they hold these assets listed here. Some of the biggest assets in crypto, by the way, you got Ethereum Classic, the Graph, Decentralized, Near Protocol as well. Is another one that they have some exposure to. But I went on to DeFi Llama and I had a look at some of their venture capital investments to look at some of the smaller projects that could be affected. And I was kind of shocked, because if we go through the rounds that they participated in, so all the projects that they had invested in over time, like Polymer Labs, obviously we got the Graph, a little bit in Polygon, even Paradigm, Atlantis, like Elliptic, some of the projects that aren't even listed in their portfolio because they're too small. These are also projects that they may have exposure to because they invested in them according to the DeFi Llama fundraising rounds dashboard. So this contagion does run quite deep, because if they're forced to liquidate assets, if they go into bankruptcy, then they'll definitely be forced to liquidate assets. If they restructure, they're forced to liquidate partial assets to make things at least able to keep ticking along. Then they'll need to obviously sell some crypto at discounted prices, which puts pressure on many small projects and some big projects which aren't necessarily which they have exposure to. So my worry is that this contagion could spread even further. Now, is it a reason to panic with these protocols specifically? Maybe not, but I would be very, very wary if I were you and if I was holding any of these projects. Maybe it's not a reason to panic. I wouldn't be max shorting now after a massive dip. That would be stupid. But I would be wary, because I think there's news to come out. And the reason I'm doing this video today is because I think we're going to get some news over the next week about what is really going down with DCG, because this sell-off is very weird and it's slightly out of character to see all the coins in their portfolio. I don't think it's a coincidence that basically all the coins that they have exposure to are dumping harder than the other coins on the market. But even if they just sold a little bit onto the market, I don't think this dump happened in isolation. It's not just DCG. We could see a widespread sell-off across crypto at the moment. So clearly they've been selling into weakness. When you sell into weakness, that exposes yourself to obviously more severe wicks. So off the back of the FOMC, where the Fed was a little bit hawkish, I guess, taking the rates to 4.5%, they implied higher rate hikes next year through the updated and revised dot plots. However, nothing they said really shocked me. I think the market was just taking Jerome Powell's words as maybe a little bit more hawkish than it hoped. The expectation of maybe a 25 basis point hike Q1, that's slightly decreased, and it's resulted in people saying, well, I guess Jerome Powell's kind of towing a hard line here. He's not going to stop until the job is done, even if that means hurting the share market, even if that means hurting the economy. He's still going to continue on his path. And although there were certain lines which I did interpret as dovish, overall, I think you could say it was slightly more hawkish than we'd like, given the fact that CPI data was fairly positive and coming down. So this resulted in a share market sell-off. Over the past few days, we've seen a sell-off of roughly 6%. That's exactly why Bitcoin ended up dropping. Despite reacting quite positively to CPI, Bitcoin ended up dropping as well. And obviously, Bitcoin typically drops further than the S&P when Bitcoin drops. So this was 9% versus SPX at 6%. So Bitcoin pulled back, and a lot of the altcoins followed. So when DCG was selling some of these assets, now I must say that it's not confirmed that they're selling, of course. I'm just kind of going out and anticipating that they are selling because of the data that's right in front of us. If DCG is selling into weakness, then this does result in more severe price action to the downside than you'd get if you were selling into no weakness. If you were selling into a bull market, obviously the market can absorb it. But given the fact that the stock market was pulling back at the same time, Bitcoin was pulling back at the same time, and maybe they were being forced to liquidate at the same time, it resulted in some crazy drawdowns for a lot of their projects. And this doesn't even do it justice. If you look at this chart 5 hours ago, when they first started selling, some of these numbers were like 30%, 25%, 20. It's gotten a little bit better because it's day on day. It's not hour on hour. It's the change in the last 24 hours. So it's all very crazy. My summary with the DCG thing, before I get into my kind of general market plan and update, my summary would be, I don't think it's time to panic before we get clarity over what DCG is doing. They haven't made a statement yet as to whether they are in a restructuring process, whether they're going to file for bankruptcy. We don't really know what they're doing. For all means, they could be continuing to try and raise capital, but I would be very, very wary of the DCG assets at the moment, and I would be wary of the potential of further contagion, and I would just wait and kind of watch for a DCG update. And I do think we are going to get news, potentially bad news on the DCG front over the next week off the back of this. Now, I want to go through my plan quickly because a lot of people have been asking me, like, Miles, are you buying? Are you kind of buying this dip? Is it time to accumulate? What are you doing? And I kind of want to go through a few key points just to kind of reiterate the plan that I've been executing over the past few months. So the first thing I want to say is I don't DCA blindly. I think if you're in crypto and you're quite in tune with the market, and you're a regular participant, as I know a lot of you are, then there's no need to DCA blindly. What I mean by this is kind of just like DCAing every month, same amount, very linearly, and kind of not flinching. Now, although this strategy, in my opinion, could actually work over the long term, that's not something I do because I'm more in tune with the market. I kind of actively trade a lot more. I like to spot new narratives. I like to spot new trends. So what I do instead is I follow something called the Costanza rule. Now, the Costanza rule is a premise that you should think differently and do the opposite of other people and not be afraid to do the opposite. So in crypto, this could be applied as simply as buying when you feel like selling and selling when you feel like buying. Now, a lot of you may think that you want to be selling right now. So by this logic, you should be buying right now. However, I apply this a little less straightforward and a little more practically to my crypto journey, which is if you have a time horizon, let's say over a 12-month period where you want to accumulate, let's say you think there'll be a bottom over the next 12 months, applying the Costanza rule would simply mean you accumulate on extreme red days to get your overall cost basis down, and you take partial profits on extreme green days and extreme green periods to take profits and continue to contribute to your stablecoin balance. You have to remember, we're in a bear market, so DCAing blindly, just buying every month, maybe isn't the best strategy. If you have a lot of money, like if you're sitting on a crap ton of cash, then yeah, it makes sense. But for me, since I want to keep a large percentage of my portfolio in stables, I need to continue topping up that balance. So I do use the green days as a chance to take money out of the market, and then I use extreme fear as an opportunity to top up some of my bags. Now, I treat Bitcoin and ETH very differently to my altcoins. This is something I got to make clear because I see people getting so confused on Twitter and on YouTube about this. When I say I'm DCAing, oftentimes this just means Bitcoin and Ethereum. Over the last few months, basically 50% of all my buys have been Ethereum. So Bitcoin and ETH, you can probably DCA for like 2 years and be pretty comfortable that in 5 to 10 years' time, you're going to make money because it's Bitcoin, it's Ethereum, they're around. I have extreme conviction Bitcoin will be considered digital gold and rival gold in, let's say, 10 to 15 years. I love Ethereum as a technology stack. I believe in a multi-chain future where Ethereum is kind of at the head of that with all its L2s operating underneath it. That's my belief. And I like both of those assets for different reasons. However, treating them the same as you treat your altcoins would be unwise. What I mean by this is DCAing every month into altcoins. That's an easy way to get burnt for a couple of reasons. One, you don't know which altcoins are going to perform next cycle. Two, by the time next cycle comes around, the narratives are probably going to be extremely different to what you think they are now. And three, you're going to have to experience severe drawdowns. And the unfortunate thing is if you don't have the stomach to do that for a long period of time, potentially 12 months plus, you're going to experience drawdowns and likely not even stick to your plan, which means the whole point of DCAing was eradicated because you didn't stick to your long-term plan. So unless you can do it and not flinch and you have conviction in certain narratives, it's best just to treat Bitcoin and ETH differently to the rest of your portfolio. And that's what I do. And of course, this is not financial advice. It's whatever your own financial goals are. But I've got to treat them differently. Now, this doesn't mean I don't invest in altcoins because, in my opinion, liquidity is king. So what I'm doing at the moment is keeping a large percentage of my portfolio in stables, right? Maybe 30, 40. I can't even give you an exact percentage because it does change on the month, and I'm very heavy in equities and traditional investments as well. Maybe let's say 30 to 40% if I had to give a rough estimate. But liquidity is king because what it means is if you can keep enough cash on the side, there's always going to be more opportunities. So there's no need to FOMO into this market. If you see DOPEX running, if you see GMX running, why are you FOMOing into those assets when you have another 99% of the market that is down? And if you have the foresight to pick future narratives, those trends will turn around. And those assets will be the ones that give you a better risk reward than trying to FOMO into assets that have already pumped. So liquidity is king because there'll always be more opportunities. And if you have money on the side, that's the only way to take advantage of these new opportunities. Now, over the next 6 to 12 months, there are going to be many opportunities. The market will likely go much lower, in my opinion. But that is why you need liquidity. And when opportunities come around, if you have liquidity, you can take advantage of them. So just start to think about taking profits on green days to make sure you always have liquidity. Because, yeah, a lot of people get confused. And I even said on Twitter the other week that I was buying some assets. And now I'm getting messages today, people saying, oh, you bought a month ago. Now the market's crashed. You're an idiot. Guys, I take profits. In that month, there was massive opportunities to take profits during that time. If you're doing that and you're continuously adding to your stablecoin balance, you can continue to reposition yourself and lower your cost basis. That is how I trade. Following the Costanza rule, following DCAing that's not linear, but that is variable depending on market conditions, and keeping an eye on new opportunities and using a liquidity to my advantage to get into new opportunities and get out. A lot of altcoins you don't want to hold for 3 years. A lot of altcoins you want to get into the trend and get out and make your money. Put some into Bitcoin and ETH, keep it in stables, and then look for the next opportunity. Now, there are assets, which I do believe long-term are decent DCAs and that you can just hold and not worry about. I probably would put BNB into that category. I know it's getting fudded a lot at the moment, but BNB is one of them. I'd say Matic is another one of them. In a few years, like I have extreme conviction Matic will be around and be an industry leader. Their biz dev team is awesome. But in general, you can't treat every shitcoin like Bitcoin and Ethereum. Now, I just need to do that rant very quick because a lot of people are like panicking and I'm seeing all this craziness on my feed. It's like, guys, we're about to get generational buying opportunities. You have to stay mentally in this game. If you could stay in this game and keep looking for new opportunities and keep well positioned in terms of your allocations, you're in the best position of the last decade or the last few decades to take advantage of what could be a potential extremely fruitful investment in a generational technology. I mean, this is crypto we're talking about. This is like, we're on the forefront of, in my opinion, what is a technological revolution. And we're getting so caught up in the 1 and the 2 month trends and the 3 month trends. Like, let's just zoom out a little bit, stick to the plan, accumulate damn Bitcoin and ETH, maybe a few other select alts, keep liquidity, get into new opportunities, get out, take profits, and watch the stream I did with Jordy yesterday, because we talked a lot about this, which was my strategy his strategy. We talked to him because I was interviewing him about when he thinks Bitcoin will bottom, best cryptos for next cycle, all that sort of stuff. So I recommend checking out that video if you haven't. Like, it's so alpha packed. Honestly, it's the best. Well, it's an hour and 40, but if you watch on 2-speed, it's like, 45 minutes. It's the best 45 minutes you'll spend of your life, basically. He's just such a knowledgeable guy in crypto, and I recommend checking that out. He probably could explain his plan a lot more eloquently than I can, and the narratives that he's looking at. Now, I also see some questions, and I've seen some in the comments today, like Rand says something differently to what Sheldon's telling me, to what Carl's telling me, to what I'm telling you. We all have different opinions. Rand approaches the market very different to me for a few different reasons. One, he has a lot more money. Two, he's in a very different position. And three, he trades with a different thesis. So Carl also approaches the market very different to me. He also has a different amount of money. He also trades with a different thesis. We're all in different situations, right? Sheldon approaches the market very differently to me. Hustle approaches the market very different. Like, we all have different plans. So if you think we're giving you contradicting info, what I would recommend is, like, just find a style that works for you based on your risk tolerance. Find the education throughout the channel that best applies to you, and work out which style you resonate with most. The way Rand trades might really suit you. You might want to be more passive and just TCA over time. The way I trade might suit you. You might want to take advantage of new opportunities, be a little more kind of geared towards, like, getting in and out on trends. The way Carl trades might suit you. In fact, if you've been following Carl for the last few months, you probably would have made a lot of money. He's been shorting. So that's what I would really reiterate. Just find a strategy that works for you and your risk tolerance and your needs. And don't get too confused. Outline your own plan and tweak it over time instead of kind of trying to take in all this information and getting confused. Because I do see that question quite a bit. So speaking of my plan, given the statement I made, liquidity is king, that also gives me room to trade. I do a bit of leverage trading because, like, I think I put like 5 to 10% of my portfolio into leverage trades. Just because, like, I find it's a valuable way to continue to kind of keep some profits ticking along in this market. I'm up 81% on my ape short. I took a lot of profits, so the P&L's lower. This ape short was brilliant. I actually gave this to you guys, like, what was it, 10 days ago? I kept it open, took some profits, set a pretty high stop loss at entry. So, like, once I was in the green, I could just continue riding this. I'm going to keep riding this, and I've lowered my stop as well. So yeah, that trade did very, very, very well for us. Basically, all the shorts did very well. The short-term long did well, but unfortunately, like, it depends, like, where your take profit was. So I don't know if you guys got into that trade on Friday. It did well for the first few hours, and then you would have gotten stopped out at entry if you moved your entry, which isn't like a bad result, but it just depends on how you trade. But basically, what I'm trying to say is I use a percentage of my portfolio to trade. I'm not actually, like, I can't possibly trade this price action right now. It's ridiculous. So I'm not opening a trade today, but I certainly will look at probably a short next. If Bitcoin pushes up, the next couple levels we've got is a 1700 level. And then if we break through here, then it's probably another opportunity to short at 17.3. So those are kind of the two levels I'd look at. Potentially could give us good short opportunities because clearly the trend's bearish. And I'm not going to long here. Like, no, there's no way I'm going to long here. It'd just be stupidity in my opinion. So you got to follow the trend. The trend is your friend to the end of the trend. The trend's bearish, so we're shorting more than we're longing. It's really that simple when it comes to trading. So if you do want to trade, you can do so on Apex. There's a link in the description. They're doing a trade to earn program, so the more you trade, the better. And they just implemented variable leverage and stop losses. Just in case you guys don't know, Apex is the decentralized partner to BYBIT. So there's kind of been a lot of concerns with trading on centralized exchanges recently after the whole FTX thing. After there's been a lot of Binance FUD, the Crypto.com FUD, people don't really trust them. And I completely understand that. If you're one of them and you want to trade on a DEX, then Apex is good because it's built on ZK rollups on layer 2. So it's fast, it's easy to use, and it's a good DEX alternative. So link in the description if you want to use Apex. It's a good place to trade if you don't want to trade on a centralized exchange. If you have a BYBIT account, it's just as simple as clicking on derivatives on your BYBIT tab and then clicking Apex because they're linked. So there's a link straight to Apex. If you're not a trader and you are a bit more like me, you're more you're more skewed towards the investment side, then I do have a portfolio where I'm implementing my DCA strat on. This is a nested portfolio. The main one's built on Polygon, and you can invest in it. And essentially what it will do is DCA for you over time, but based on when I choose the DCA. Now, you'll get a prompt in your wallet if you're copying this portfolio to make a trade or make a change to the portfolio based on a change that I made. So I'm going to be editing this, altering this over time, over the next 12 months. In line with my time horizon, I will be DCAing into this. So if you want to join along, then you can copy. At 105 copies, I'm giving away to 2 people $1,000. So link in the description to copy the nested portfolio, and I'll be continuing to build portfolios over time. It's just I'm not really buying right now, so that's why I haven't created a new one. And you'll notice there's 88% in stablecoins here because we want to DCA out of stables into these assets over time. So I'm going to continue to tweak these. They're only assets that I'd hold long term. They're not assets that I'm trading. If I do trade an asset, I might get in and get out, but obviously you're copying me, right? So you'll get prompt to do so. So I'm going to answer a couple questions just quickly before I head off. Bottom's not in. Next year, probably. I've been saying this for months. Once again, I saw some tweets today on my Twitter. Someone said, Miles, you've been calling the bottom for the whole year. Firstly, not once have I called the bottom. I've called local bottoms because that's for trading. In terms of generational bottoms or cycle bottoms, I've been saying for a long time, Q2 2023. You can watch my old videos. For the last 6 months, I've been saying like Q1 to Q2 2023. My thesis is still in line with that the bottom is next year. That's still my thesis. I could be wrong. I don't claim to be an expert. I don't claim to be able to pick bottoms. In fact, my thesis is that you can't pick bottoms, and that's why we shouldn't try. But if you are trying and pick the bottom, Q2 is what I'm looking at. Solana versus Matic versus Cardano, biggest upside in the bull market. Biggest upside Solana, biggest upside Solana, best hold Matic in my opinion. Cardano is not a good hold in my opinion. Best hold Matic, so DCA and hold long-term Matic. Upside play Solana. Solana probably also drops more though, so Solana's more probably like a shorter-term rotational trade. But I mean, you could probably stack it as well, maybe next year. But obviously, there's a lot of potentially more downside to come. Wonderful Miles stablecoins though. BUSD, USDC, USDT. They're the 3 I'd diversify 30-30-30. What about Phantom? Phantom will probably constitute like 1 to 2% of my portfolio. I still have a small position in Phantom, but that's another one that I'll probably look at buying. When I do my big buying, which I haven't done yet, that'll be next year. Like when I talk about big buying, I mean size where I like fully go in. Because I'm still like pretty heavy in cash, then Phantom will be one of them. Atom, don't love the Atom token, man, but as I discussed with Jordy yesterday, the Atom ecosystem is interesting. You've got Injective, you've got DYDX launching their chain, you've got Kujira, you've got a few other projects launching on Atom that look very cool. We discussed it yesterday, so I wouldn't buy Atom, but I would buy the projects underneath Atom for exposure to the ecosystem. That's what I'm looking at. Arweave is one of the only projects I would hold long term. So I said to you guys, I wouldn't DCA blindly into alts. There's maybe like 5 that I would. Arweave's probably one of them. Gala, I'm not investing in gaming yet until the narrative shifts. I don't see the point in DCAing and just losing money for the next year on gaming unless there's a turning point. Gaming, we'll have signs when the gaming market's starting to pick back up. I just don't really know what the winner's going to be. Gala's tokenomics also aren't the best, so holding Gala long-term just doesn't make that much sense to me. Link, yeah, probably also fits into the category of coins that you could hold long-term because it's just so solid. But I'm certainly not going crazy risk on. Like honestly, guys, I'm always going to keep 100 with you. Like my focus is continuing to build up cash, whether that is through trading, whether that is through. I've made some great buys. I've obviously Dopex, GNS. They won 200% trades just in the last month that we've been able to hit. And that's amazing because we could take profits off those, put them into stables, and now we've made more stables. So just because I'm not making big buys now doesn't mean I can't make money in the meantime. There's many opportunities to make money in the meantime. That's one of the things my show is dedicated to, helping you guys find those opportunities. You just gotta trade the hype game. We saw GNS and GMX were exploding. We got in and we took heavy profits. It's not a game where we buy a GMX and we hold for 5 years. No, because eventually that could go to zero. Why would I want to hold GMX for 5 years? It's not, GMX isn't in the same league as Ethereum. And that's what I was saying by my point before of saying it's a mistake treating Bitcoin and ETH like alts, because it is. You don't, not every alt you buy has a 5-year time horizon. Some have a week time horizon, some have a month, some have 2 months. So that's part of the reason why I will take heavier profits on those assets. I don't know if you've listened to anything I've said today, David, but people get very confused between linear and variable dollar cost averaging. And what dollar cost averaging is it's just kind of a general definition which has many sub definitions underneath it. Now, DCAing could be as simple as buying $100 of Ethereum every month for the next 5 years. DCAing could also mean following the Costanza rule and buying $1,000 when the market's red, and then selling $100 when the market's green, and then buy another 1,000 when the market's like. DCAing just means averaging. Averaging doesn't specify that it needs to be continuous, and it doesn't specify what asset it needs to be in. So this whole DCA's crap logic is not true. DCAing blindly is crap. That is the distinction I think I got across in today's video, but maybe you completely misunderstood. And you know, if you misunderstood that, then that's up to your that's up to you. That's your fault. No DCA bad timing. I don't know exactly what this means, but I think I will emphasize the last bit of that comment, which is timing. Timing is extremely important. DCAing with timing is brilliant. DCAing without timing often is bad unless it's like Bitcoin and Ethereum. Then I think it's okay, although some people have made cases for that being a bad move. Let's go through the comments, see what other people said. Don't think the bottom's in. Neither do I. Neither do I. I don't think it's in either. I don't think it's in. Like, the percentage chance it's in is lower than it's not in. So let's just trade based on the thesis that it's not in. And if it is in, it's fine. You don't need to time the bottom. You don't need, you'll still be happy with some exposure, even if the bottom's not in. And if the bottom does go in, then that gives you more opportunities to accumulate. So either way, you're fine. The best plans are plans that don't rely on directional bias. The best plans are plans, obviously maybe over the long term we have directional bias. It's clearly long. But the best plans, at least in the interim, the next 1 to 2 years, are plans that don't rely on direction and are well formulated to keep you mentally sane, irrespective of what way prices move. That's why I'm still more motivated than ever in this market. I'm not flinching at all. The market's down 90%. I'm still having so much fun finding new opportunities, finding new coins, researching, because I have long-term conviction. If you don't have it, then no wonder you'd be struggling mentally, because you need it in this game. Binance is fine. I want to put that FUD to rest. All right. I think this sums up the video. I'm going to head off now, enjoy my weekend. I kind of did an emergency stream because I wanted to clear up some of the misconceptions around DCG because I've been hearing a lot of it. Hopefully you guys have some more insight now into what went down with 3AC, what went down with the Grayscale trust, and potentially what might happen to it. I'd just be very wary of the assets that are being sold off, and I would expect news, potentially bad news over the next week, which could continue to affect those tokens. So they aren't tokens I'm trading. I'm kind of staying away from them for now. Let's see over the next week how it plays out. And hopefully my plan gave you guys a little bit more insights into how I'm approaching this market. I will do a more kind of simplified breakdown version in the future though, so we can all be on the same page. Quit picking your nose. I'm not picking. I have hay fever and it's itchy. And the Clarentine, the drug that you take for antihistamine, hasn't kicked in yet, hence why I'm itching my nose. All right, cool. I'll see you guys in the next one. Peace out.